Stop right there. I need you to listen to me very carefully, because what I'm about to tell you could save you thousands, maybe even tens of thousands of dollars, and it's something so many intelligent, well-meaning investors completely overlook. This isn't some obscure financial jargon or a trick for the ultra-wealthy. This is a powerful, perfectly legal strategy called tax loss harvesting, and if you're not doing it, you are absolutely leaving your hard-earned money on the table. Here is the reality. The world of investing is volatile. We all know that. Sometimes your portfolio soars, and sometimes, well, sometimes it takes a hit. But here's the secret. Those hits, those losses that feel so painful, they can actually be turned into a strategic advantage, a way to offset the taxes you pay on your gains. I want to save you from the nightmare of paying more in taxes than you absolutely have to. Let me explain why this matters so profoundly to your financial future, and how you can implement this strategy starting today. So what exactly is tax loss harvesting? In its simplest form, it's the act of selling investments that have lost value to offset the capital gains you've realized from selling other investments that have made money. Think of it like this. Imagine you've had a fantastic year in the market. You bought some amazing tech stocks early on, and they've skyrocketed, but you decide to sell them, maybe to rebalance your portfolio, maybe to fund a new house, or maybe just to take some profits. Fantastic! But now Uncle Sam comes knocking, ready to take his cut of those capital gains. That's where the pain comes in, right? You've made money, but a chunk of it has gone to taxes. Now, what if I told you that in that same year you also had some other investments that didn't do so well? Maybe a speculative biotech stock that tanked, or a bond fund that dipped due to rising interest rates. Those are losses, and while they sting, they are not just dead money. With tax loss harvesting, you can strategically sell those losing investments, realize those losses, and then use them to directly reduce the amount of capital gains you have to pay taxes on. It's like a financial shield against your tax bill. Now, I know what some of you are thinking. Why would I want to sell something at a loss? That just makes it real. And that's a common misconception, a psychological hurdle that trips up so many investors. The idea of locking in a loss feels like admitting defeat. You might be holding onto that losing stock, hoping it will eventually come back, right? But here's the crucial insight. If you've already identified that investment as a long-term loser, or if you simply need to reallocate your funds, turning that unrealized loss into a realized loss through selling allows you to put that loss to work for you today. It's not about admitting defeat. It's about strategic victory in your tax planning. The consequence of getting this wrong, of not doing this, is simply paying more taxes than you need to year after year, eroding your wealth unnecessarily. And who wants that? Nobody. I want to empower you to take control. Let's dive into a specific scenario to make this crystal clear. Imagine you are Sarah, a diligent young professional in her early 30s. She's been investing consistently for 5 years, building a solid portfolio. This year, she sold some shares of an S&P 500 ETF that she bought years ago, and she realized a healthy $12,000 in long-term capital gains. That's fantastic. But Sarah also dabbled a bit in some individual stocks, and one of them, a smaller tech company she believed in, unfortunately went sideways and is now sitting at a $7,000 unrealized loss. If Sarah doesn't do anything, she's going to pay capital gains tax on that full $12,000. Depending on her income bracket, that could be anywhere from 0% if she's in a very low bracket, which is rare for someone realizing gains, to 15% or even 20% for most people. Let's say she's in the 15% bracket, she'd pay $1,800 in taxes on those gains. Ouch. But Sarah is smart. She watches this channel. She remembers me telling her about tax loss harvesting. So she decides to sell that losing tech stock, realizing the $7,000 loss. Now here's the magic. That $7,000 loss directly offsets her $12,000 gain. Instead of paying tax on $12,000, she now only pays tax on 5 COG. $12,000, $7,000. At a 15% tax rate, that's only $750. She just saved $1,050 simply by being strategic with her losses. That's real money that stays in her pocket, money she can reinvest, save, or use for something she truly needs. This isn't just a one-time thing. This is a powerful habit that builds wealth over time. Now here's where it gets even better, and where many people miss out significantly. What if Sarah's losses exceeded her gains? What if she had $15,000 in losses and only $12,000 in gains? She could offset all $12,000 of her gains, bringing her taxable gains down to zero. But she still has $3,000 of losses remaining. Can she just throw those away? Absolutely not. The IRS allows you to use up to $3,000 of net capital losses each year to offset your ordinary income. This means if Sarah has a salary from her job, she can reduce her taxable income by $3,000. For someone in a 22 or 24% income tax bracket, that's another $660 to $720 in tax savings. And what about any remaining losses after that $3,000? They don't disappear. You can carry them forward indefinitely to future tax years, offsetting future gains or another $3,000 of ordinary income each year until they are used up. This is a perpetual tax-saving machine if you manage it correctly. I want to save you from this nightmare of letting those valuable losses expire unused. This strategy is absolutely critical for various demographics. Let's consider Mark, a busy freelance graphic designer. His income can be unpredictable, sometimes booming, sometimes slower. He's also an avid investor, trying to build his retirement nest egg. This year, Mark landed a huge contract, and his business income is significantly higher than usual. He also made some smart moves in the stock market, realizing $20,000 in capital gains from selling some growth stocks. But like many of us, he also took a bet on a couple of newer, riskier companies that didn't pan out, and he's sitting on $10,000 in losses from those holdings. If Mark doesn't harvest those losses, he's paying tax on $20,000 in gains, on top of his already higher ordinary income. This could push him into a higher tax bracket, not just for his capital gains, but potentially even impacting other aspects of his finances. But by strategically selling those losing stocks, he can reduce his taxable gains from $20,000 down to $10,000, saving him a substantial amount. And what if Mark had a really bad investing year? Say he had $25,000 in losses and only $5,000 in gains. He'd offset all $5,000 of his gains, then use $3,000 to reduce his high ordinary freelance income, and still have $17,000 in losses to carry forward for future years. For a freelancer with fluctuating income, this ability to offset ordinary income is a game changer, providing a crucial buffer against high-income years. This is about smoothing out your tax burden and maximizing your financial efficiency. Now let's talk about Eleanor, who is nearing retirement age. She's been investing for decades, and her portfolio is diversified, including some old blue-chip stocks with significant embedded gains, as well as some newer investments, perhaps an international equity fund or a sector-specific ETF, that have seen recent downturns. Eleanor might need to sell some of her long-held winners to fund a large expense like a new roof for her house, or to supplement her income in retirement. If she sells those winners and realizes $30,000 in gains, that's a big tax bill waiting. But by carefully reviewing her portfolio, she identifies $20,000 in losses from those underperforming funds. By harvesting those losses, she reduces her taxable gains from $30,000 to just $10,000. This is not just about saving money, it's about preserving her hard-earned nest egg. For retirees, managing taxable income is paramount, as it can impact everything from Medicare premiums to the taxation of Social Security benefits. Every dollar saved on taxes can mean a higher quality of life in retirement. This is about securing your future, not just this year, but for all the years to come. So, how do you actually do this? It's simpler than you might think, but it requires diligence. First, you need to identify your losses. Go through your brokerage statements. Look at any investments you own in a taxable brokerage account. This doesn't apply to tax-advantaged accounts like 401ks or IRAs, as those gains and losses are not taxed until withdrawal. Find those stocks, ETFs, or mutual funds that are currently trading below your cost basis. Then, identify your gains. These are either gains you've already realized by selling profitable investments this year, or gains you anticipate realizing before the end of the year. Once you've identified your candidates, you simply execute the sale of the losing asset. That's it. But here is the most critical rule, the one that trips up almost everyone and can invalidate your entire strategy, the wash sale rule. Stop right there. This rule states that if you sell an investment at a loss, you cannot buy the same or a substantially identical security within 30 days before or after the sale. If you do, the IRS disallows the loss. I want to save you from this nightmare of an IRS audit or disallowed losses. So, if you sell Apple stock at a loss, you can't buy Apple stock back for 30 days. If you sell an S&P 500 ETF from Vanguard, you can't buy the same Vanguard S&P 500 ETF back for 30 days. But here's the clever workaround. You can buy a different but similar investment. So if you sold a Vanguard S&P 500 ETF, you could immediately buy an S&P 500 ETF from iShares or Spedger. They track the same index, so you maintain your market exposure, but they are not substantially identical in the eyes of the IRS. Or if you sold a specific tech stock like Google, you could buy an entirely different tech stock like Microsoft or a broad tech sector ETF. This allows you to harvest the loss while remaining invested in a similar asset class or market segment. Beyond the wash sale rule, there are other nuances. Remember the distinction between short-term and long-term capital gains and losses. Short-term gains from assets held for 1 year or less are taxed at your ordinary income rate, which is typically higher. Long-term gains from assets held for more than 1 year enjoy preferential lower tax rates. The IRS has specific rules for how losses offset gains. Short-term losses first offset short-term gains, then long-term gains. Long-term losses first offset long-term gains, then short-term gains. It's a specific pecking order that your tax software or accountant will handle. But it's important to understand that a short-term loss is generally more valuable because it can offset higher tax short-term gains or ordinary income more quickly. Don't let this complexity deter you. Your brokerage statements will provide the necessary cost basis and holding period information, and most modern tax software is adept at handling these calculations once you input the sales. The crucial step is doing the harvesting. When should you do this? The clock is ticking. You need to execute these sales before the end of the calendar year, typically December 31st. However, don't wait until the last minute. Trades need to settle, and market conditions can change rapidly. Give yourself a buffer of a few days. Many smart investors review their portfolio for loss harvesting opportunities in November or early December. This isn't just a year-end scramble. It can be an ongoing strategy throughout the year, especially during market downturns. If you see a major dip, that's often a prime time to identify and harvest losses. Finally, I want to address the psychology again. I know it feels uncomfortable to sell something at a loss. It feels like admitting you made a mistake. But in the world of smart investing, acknowledging a mistake and turning it into a tax advantage is not a failure, it's a profound success. It's about being proactive and strategic. Don't let inertia, fear, or a misunderstanding of the rules cost you thousands of dollars that are rightfully yours to keep. This isn't just about saving money this year, it's about building smart financial habits, taking control of your tax situation, and ultimately accelerating your journey towards financial freedom. Review your portfolio. Talk to a trusted tax professional if you have complex situations. You have the power to take control of your financial destiny and make your losses work for you. Don't let this opportunity pass you by. The clock is ticking. Take action now.